Hello and welcome to the Weekly Watch, a podcast series that cuts through the noise with our latest analysis on themes and events that are shaping global markets. My name's Paul Robson and I'll be your host this week. It was a week of central bank meetings, completely dominated by central bank meetings. For some, it gave an opportunity for central bankers to act on their guidance, their hints that interest rates needed to rise to cool inflation pressures. For other central banks, it gave them an opportunity to give their take on the recent move in short-end interest rate markets that had moved to price in earlier and more aggressive rate hikes. Within this, the theme was very much on central bank reaction functions to a shifting growth and inflation outlook. Now, the week was kicked off by the RBA. They dropped their yield curve control policy framework. It was always in the balance, but it looked like that was going to be ditched because they hadn't been following through with their policy in recent weeks. They did stress patience around the need for interest rate increases in the future. In emerging markets, we had consensus beating rate hikes from the Polish and Czech national banks. They continue to face quite acute inflationary pressures. Some might look for a read across from those central banks to the ECB. We don't think that that's correct. The inflation outlook in the euro area is sharply different from that in other parts of Europe. For the Fed, it was very much mission accomplished. They managed to deliver a taper of their asset purchase program without any tantrum. In fact, you would struggle to notice any market moves on that decision itself. The way I look at it from a currency perspective is dollar yen, because it's very sensitive to interest rate expectations, and it hardly moved a pip. For the Fed decision, drilling down into the details a little bit, there was no dramatic pushback on market expectations that a policy rate hike might come next year. But I think the crucial angle for the Fed is that they gave themselves plenty of wiggle room around the policy outlook. When they talked about tapering, it was about November and December. There was very little about the run rate into next year, and that just allows them to tweak the rundown in asset purchases. And that's important because the quicker they can get through the rundown of their asset purchases, it brings the timing of that first important rate hike from the Fed. So watching for the optionality the Fed has now around the outlook. But the actual biggest surprise of the week came from the Bank of England. The Bank of England's actually inaction to raise interest rates as the market had expected. Now, I'm very happy to say that my special guest this week is Ross Walker, NatWest Chief UK Economist and co-head of Global Economics, to help me work out the key takeaways from the Bank of England. So Ross, maybe we can start very much with that decision from the Bank of England. Looks like the market was ready for a rate hike. They didn't get it. How do you see that decision?
Yes, the market had fully priced a 15 basis point rise. Why did it not come at this point? I suppose in terms of the fundamentals, the governor in the press conference did seem to stress some uncertainties around the labour market. He noted that the numbers on the furlough scheme at closure were significantly higher than the bank had expected, roughly double versus what they expected back in August on the previous forecast. So that might have induced just a little bit of caution. Some policymakers quite reasonably wanting to see a few more months of data, we suspect, from the labour market before pulling the trigger on rates. And the governor also pointed out that his comments about interest rate rises being needed were phrased in a way that the rises were conditional on certain things happening, and those conditions hadn't necessarily been met. And I think maybe one of the lessons in terms of this Bank of England's policy guidance is that markets perhaps expected, or they expected a more sort of micromanagement approach, a sort of running commentary on interest rate futures pricing, and this BoE doesn't seem inclined to do that. So I think maybe going forward, you have to look at their guidance in more broad brush terms and not necessarily link it to very precise moves in interest rate futures markets.
So we didn't get the rate hike from the Bank of England last week that markets expected. So when do you expect that first crucial rate hike to come?
Well, I think the obvious point is probably the February 2022 meeting rather than the next meeting in December this year. February will be the next quarterly forecast round. As I said, I sense that they want to see a little bit more labour market data. They're maybe not in quite as much of a rush as financial markets had expected. I think if you in delivering the first interest rate rise of the cycle, even a well-trailed rise, it's probably easier to do that in the context of a quarterly forecast update. You also have the scheduled press conference, so the bank has an ability to communicate its message, to shape expectations in a way that it is slightly harder to do in a non-monetary policy report month. So to us, February feels materially more likely than December for the next rate rise. Though interestingly, the market is still, although it's been scaling back its interest rate expectations, it is still pricing in a move in December.
So that's all very clear. So I always think that rate hikes never travel alone. So, you get one rate hike quickly followed by another. Do you have any sense of where interest rate rises might start to peter out, the sort of terminal rate for rates in the UK?
Yes. If you look at the Bank of England's forecasts that they published, they have inflation just fractionally below the 2% target in the second half of the final year, the third year of their projection. And that inflation profile rests on bank rate rising relatively rapidly to around 1% by the end of next year, and then essentially leveling out. So in other words, the BoE seems to be pushing back just a little against that market pricing as being a bit too aggressive. Our forecast is for a 15 basis point rise in February to 0.25%, a relatively quick follow-up, another quarter point rise to 0.5% in May. You then get some of this passive QE runoff as they breach that 0.5% threshold on bank rate, and then one final quarter point rise in November to 0.75%. So I think based on the Bank of England's latest November forecasts, something like 75 basis points on bank rate by the end of 2022 seems reasonable. That might not quite be the peak in interest rates, but I think there is a sense that the neutral rate or the level rates have to rise to give the bank more confidence that they'll meet their inflation target in the medium term is probably in that sort of territory, around the 1% mark.
Thanks, Ross, for providing us with your latest thoughts on the Bank of England. And thanks, everyone, for listening. If you'd like to check out our other podcasts or receive our analysis, please follow us on social media and head to ci.natwest.com. Have a good week, everyone, and bye for now.